I just want to highlight something real quick that there's no drawings on this chart. As you can see, the drawing tool is turned off. Yet it looks like there are. And I'm really genuinely proud of the progress that I've made with my coding because it is making trading, it's making generating discretionary trade signals so much easier. So if I turn these two indicators off, you'll see that it clears the chart. Now there's truly no drawings. We have stop hunt range, which is the logic of this indicator. You'll see it's triggering on this candle. Is that the high is higher than the preceding 30 highs, so it's a range high. But not only that, it's a stop hunt, meaning that the whilst the high was higher than the range uh, high, the close of the candle was below the open of the previous candle. And what that's doing is that is essentially evidence of market maker intentionally getting involved in price and doing something noteworthy. So you mark that level because that this condition has proved that this is a noteworthy candle. And you'll see that you had stop hunts in and above that level, but you never got a close above. And then when you did get a close above, you had this consolidating, this widening, consolidating structure. Now, structures will usually consolidate in the mirrored uh, format, meaning that they will get narrower as they get closer to the breakout. But you can also have widening structures, and you will see that immediately once this level was broken, you had testers into the liquidity that was created. And we're not even thinking about volume yet. This is purely just price action. And then eventually, when you got clearance of this level, and when you got a close above all of those levels, you got this impulsive move away. But obviously, there's a better risk reward for having a signal generated here rather than having to wait. So that's the first part of the setup, and that's printing automatically based on the code in this indicator. It looks like a drawing, but it isn't, and that's beneficial for many reasons, but most particularly that you spend a lot of time charting or drawing these levels manually, whereas I can go to any chart and this will populate automatically because it's analyzing the price data that's presented and it is plotting this line. So I can get this on any chart, and therefore that's why I can scan so many tickers and find the trade ideas where they exist. So now we also need um, volume though, because volume is an important factor. And you will see if we just turn off stop hunt range, you will see that volume levels are being identified, and you can infer a story based on what is happening around the volume levels. So the red indicates a net sell volume level, the green indicates a net buy volume level, and you want the best signals are when the market maker is buying into a previous buy level and selling into a previous sell level. So, for example, here you had many overlapping buy levels, and the more intense the color, the more overlaps you have, and you see that they present very good opportunities within the context of this structure. So you had the stop hunt of that range stop hunt level. You had a consolidation into buy uh, volume liquidity areas. Along this level, you had net buy volume the whole time. You see the net position was increasing. So you're reading these two signals in tandem. And then when you got that signal that we're talking about, the close above the stop on range level, and you had this widening consolidation, this volume move is the signal to get long in the direction of this buying activity. So you're biased long because clearly that structure, we're going to turn drawings back on for a second, but clearly that structure is a bullish structure. But if you're just trying to find inverse head and shoulders or whatever the fuck pattern, hunt volatility, whatever the fuck, then you're not giving context to those signals. And if all you have is a hammer, everything's going to look like a nail. But I have objective volume based confirmation that this is what it looks like, and you're looking to get long at each of these levels. This is a great long, and you see the market maker agreed, wicks into that level consistently, impulsive move above the level. consolidation above the breakout, and even though you had this widening consolidation, it didn't break this level, because the logic being told here is the market maker was a buyer here to bring price higher, and as such, he will buy again on the top of the range that he created from previous buying. Then you have the wind up, you have the clearing of the level, and then when you get both the clearing of this stop hunt above the range stop hunt at this point, but you also have a high volume candle, and you also have a clearing of the volume level. It's no coincidence that when price retests there, you get an impulsive move away. But he was planning that from here and here, and now you see the volume will have increased substantially. The net sell volume will have increased, and he's already starting to lighten the position that he was taking on within the range. So I'm pretty happy with where this data presentation is at, because I didn't have to do anything on this chart. I just opened the ticker and the trade signal generated. I added to my Sun position here, because granted I did think it was going to break out from here, but you can never preclude a retest. But the idea is still valid. That's why you would never put a stop loss there. You would never put a stop loss there, because they can do this with your idea still being valid. So the logical position for a stop loss was under here, because what did I just say? The market maker was buying here. So if he, that's not to say he can never take price below where he buys from, and on markdowns that is what he will do. But the logic here is that this is a gradually increasing gradient. So if he is taking out this level, then the structure is clearly changing, so you wouldn't want to be long anymore. So that's why you would have your stop loss there, and potentially it's a more long drawn out accumulation, but you'll just keep it on your watch list and get in at one of these positions or one of these positions or even one of these positions. So that is why you don't have to know what's going to happen. You just have to logically speculate based on what you're observing, and have your invalidation points be at a logical place. So this is continuing on from the previous video, where your stop has to be where your stop has to be the logical invalidation of the idea that's getting you long in the first place. And it can't be here, because if it's there, look what happens to the people who put their stop loss in the obvious position. And this is an illiquid shitcoin, but they still come for it. They still come for it. I'm going to make this black. I'm going to make it a whole line, and I'm going to make it a big line, because this is an important fucking point. If you put your stop loss, so I got long here. If I put my stop loss under this level, or if I get long thinking that is the impulse move, whereas this is the impulse move, and I'm long here, and I put my stop loss under there because I want 200 to 1 because I'm greedy. Look, they're coming, and they come back for those people on purpose. Look at that. Sneaky, 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 and then send it in the direction that the people long here with stupidly tight stop losses, they thought it was going up. I thought it was going up here. Right? But I gave myself the leeway of a stop loss down here so I can stay in the trade. For the people who thought it was going up here, just like I did, so it wasn't necessarily a bad idea, but they had too tight of an invalidation, absolutely smash all the stop losses under that range, so there's levels to the traders. There's these traders, so everyone got in here. It's fine. There was nothing wrong with getting in there because of the structure that was being made and the support that was being found on top of the level that we previously described. So the levels of traders are the people long here with a stop loss here. That is tier one. That is the people who know structure and know what's happening. Then there is the people who get long in this level and get immediately wiped out because their stop loss is here. They literally have the most obvious invalidation points for their trades, and they're not true invalidation points, because liquidity retesting before impulse moves away is very common. So these are the level 3 traders. These are the fish, the retail plebs. Then there's the people who are watching for the retail plebs to get wiped, and they see this impulse move. They see it close above that level, and they put their stop loss there, and they're probably correctly, and it's probably high level execution, they're probably coming in on this level, at this level, at this level. They're probably buying more at this level, anticipating the breakout, and then they with the stop losses under this level, and they all get cleaned. So it's the people who have stop losses under the logical invalidation point that are safe and are get to enjoy this move. So just something to think about. It started off as a humble brag about my awesome indicators and how I can open up any chart and it will show me these levels despite not having anything drawn. Like right now, we can see selling into sell liquidity, which is a net bearish pattern, which is why I have an alert down here because I think they're going to probably retest liquidity there and I want to add to my position. I can bring up a stock pattern. You can see net selling into a sell area. You can see net buying in a buy area. You can see liquidity hunting under the buy area, impulse move through, selling into the same areas. I can just bring up any chart and the levels are there for me to trade if I want to. That's where this video started, but then it ended with a discussion on trade placement and how you can have an idea that price is going up, but it's really your execution that matters and giving yourself enough space in the trade and pushing yourself to hone your edge and hone your niche the way you're viewing the market so that you have the luxury of bringing your stop loss closer. So maybe you didn't have this luxury, maybe your stop loss is under here and you're only getting 2 to 1 or 3 to 1, whereas I'm getting 10 to 1 at that level by putting the stop loss there. And then how the elite traders will come for the fish who are just too tight because they haven't really thought about what this structure means, and it's just like they're probably buying a tip. Someone probably came on Twitter and said sun is going up, and they're just getting bored and they just have a stop loss under the obvious level. Because when you bring up any trading exchange and you bring up the ticker, they're not giving you the 5 or like they're not giving you the weekly chart, they're not giving you the daily chart. It's the minute chart or the 15-minute chart, and the what looks like the extreme points of the chart on a 15-minute chart is way different even on the hour, and especially on the daily or the weekly, the extreme points are much further away. So it's no coincidence that when you log into Binance or whatever exchange and you bring up a ticker, that it's the 15-minute chart you're shown, because they want to show you extreme market points that are actually in true perspective very close. Because on a 15-minute chart, it probably looked like a rational place to put your stop loss, because why would they take out the level if it was going up? Well, they take out the level because you're considering with what is on a macro basis at an irrelevant time frame. Like the 15-minute time frame, from the perspective of a market maker that's operating a campaign on the weekly perspective, is not important. But that's your frame of reference. Your frame of reference is deficient if you are looking at too low a time frame. And I don't even blame most people, because that's, as I said, what you're forced to look at when you log into the exchange. So this is what you would have seen. You would have seen this nice accumulation structure. Oh, it's so nice. I'll put my stop loss under this level. Smash. And then you're a level 2 trader. Oh, they've already run for the liquidity. Now they're looking towards the retest of that liquidity to then break it out. And then they will have this confirmation, they'll have this engulfing candle that brings it back into the range, and you have this support, this wick price action, because the market maker is happy to generally buy on that lower time frame from the stop losses of people who don't know any better. But then even those second level traders get wiped out by this action. And it didn't even close below in the 15-minute time frame. Like despicable liquidity hunting on that level. Big volume, that was the low, but they always, well, not always, but they really do tend to come back, because why wouldn't you? If you're a market maker looking for liquidity on the opposite side of your trade and you have 101 million stop losses here because that's the obvious low, because that's what the exchange showed the obvious low to be, that's where you put your buys, and you use your market pressure to force price towards that level. It doesn't cost you as much to do this as you're going to make when you do this. And then you totally fuck the people who you've robbed twice. You've robbed the level 3 traders, you've robbed the level 2 traders, and then you're taking level 1 traders along for the ride. And that is just how it works. These patterns are all fractal. Look at this and then compare it to this. It's all fractal. And if you put your stop loss in an obvious position, you will get run, and you deserve to get run until you learn your lesson and you learn to adjust your thinking to execute your ideas in a proper way. This is On Brain Capital, and catch you in the next video.